Assalamu alaikum friends. Welcome to Financial Reporting Practice Test 1 Part 1. Okay, so this is the paper which I've selected for financial reporting today is Practice Test 1. Okay, there are two practice test 1 and 2. The two you can attempt and I will be doing practice test 1, and this will also help those students who will have an overview of financial reporting, what it includes and all. Okay, for the ones who are seeing this uh, or who does not know what is financial reporting all about, okay, what the paper is all about, what it includes and all, for them it will be helpful, right? So previously I have done F1 to F6. Okay, yesterday I did taxation and today I'll be doing financial reporting. There will be three parts to this. Part 1 where I'll be discussing section A, section B will be in part 2, and section C, which is like the major part where many students struggle, is in part 3. Okay, so starting with financial reporting, as I promised yesterday that I'll be making a video on financial reporting, and I get many requests from students, trust me, to make a video on financial reporting. Okay, so here am I finally. Okay, so let us start. And financial reporting is mostly it's more towards calculations. Okay, you have to do a lot of calculations. Okay, you can expect a lot of calculations, especially when you have to make a consolidation account or a final accounts. There you have to do many workings. Okay, and financial reporting, another reason is you have to be good in financial reporting, the standards and all. There is no chance, because when you go to the advanced level, SBR is there, which is not optional, it's compulsory, you have SBR. Okay, so whatever is in your financial reporting will be repeated in SBR in more advanced level, so you have no option but you have to go through this. You have to learn all this concepts and the IFRS and IES, because it will be tested again in SBRs. Okay, so you have no way of escaping SBR. Okay, sorry, the financial reporting, because you'll be caught up in SBR. Okay, so let's start with section A. So section A questions, we will be having options, and or you might have to click on the correct box or select from the drop down list, or you have to type an answer. Okay, so either out of this ways you'll be asked question in section A and also section B. But the difference between section A and section B, you will be given a scenario case study, small case study. On that, you'll be asking four, 5 questions will be asked. But in section A, there's no case study. Okay, it's very simple in nature and questions are very small. So let us start. And there are 15 questions in section A. Where 2 marks each, that means 30% of your mark is in section A. And in section A and B, it could be asked from various, okay, wide syllabus. Okay, all the areas in your syllabus is tested in section A and section B. So you have no way of not studying any part of the syllabus. Okay, so let's start. Which of the following is not a duty in the IFRS Interpretation Committee? So you'll be taught what is this IFRS Interpretation Committee. Okay, what is not the duty? To answer this question, okay, you have to know what are the duties of IFRS Interpretation Committee, which will be taught in financial reporting. It will be there in your textbook and all. If you have the textbook, go through it. You will be explained, because once you know the duty, then only you will be able to understand, identify which of this is not a duty. Okay, to interpret the application of IFRS, it's a duty. It's a duty to work directly with national standard setters to bring about convergence with IFRS. Okay, see, interpretation committee. Okay, so what interpretation says, it has to interpret. Okay, come on, it's something common sense. Okay, second, to work with national setters about bringing convergence with IFRS. It's not a role of interpretation committee as so far, but don't be so quick to select the right answer. Read all the 4 options. To work guidance on financial reporting, it is not specifically addressed in IFRS. Yes, this is also a role. And the fourth one, to publish draft interpretations for public comment. It is also a role. So second one is definitely not a role of interpretation committee. Next, for each of the following, identify whether or not the accusation would be treated as a subsidiary of Polgo Company at 31st December 2007. Okay. To know whether an accusation would be treated as a subsidiary or not, you should know what are the features of subsidiary. When a subsidiary will be recognized, you have to know this. Then only you will be able to understand which one of this will not be treated as a subsidiary. Okay. So first one, The acquisition of 60% of equity share capital, their activities are significantly different from the rest of the Polygon group of companies. So the moment there's acquisition of 60% is a subsidiary. You have to understand that. Because more than 50%, you have a control. Okay, that's a rule to identify subsidiary. So it's a subsidiary. Next, the offer to acquire 70% of Hunter equity issue capital, the negotiations were finally signed off during January 2008. The negotiations were finally signed off. Okay, so this is an offer to acquire. Read the word very carefully. Most of you will click subsidiary because it is 70%. No, here the acquisition of 60%. They have acquired it. Look at the date on 1st of March 2007. It falls in 31st December 2007 that year. But this one they are offering, but they still didn't acquire. Okay, because the negotiations were finally signed off in January 2008. So it is after 31st December 2007. So it is not a subsidiary. It should fall in that year. Third one, acquisition of 45% of Speed equity share capital on 31st December 2007 is able to appoint 3 of the 10 members of Speech boards and all. So the acquisition of 45%, less than 50% is not a subsidiary. Okay, it can be an associate, but it's not a subsidiary. It will give you an influence, but not a control. You need a control. Control is more than 50%. Then you call it a subsidiary. Next. So wherever such information is given, where lots of dates are given, you have to read it in the order, okay? According to the date. So 1st of Jan 2006, okay, Garden Bugs received 30,000 garment grant relating to equipment which cost 90,000. What is it? 30,000 garment grant relating to equipment costing this one. You can highlight it here. Okay. Always highlight the important figure. And had a useful life of 6 years. Okay, this is very important for your depreciation. Useful life of 6 years. The grant was netted off against the cost of equipment. Okay, so this is the grant, this is the cost. They are saying it's netted off. On 1st of Jan 2007, that is 1 year later, when the equipment had a carrying amount of 50,000. It's okay. So 1 year later, equipment had a carrying amount. Its use was changed so that it was no longer being used in accordance with the grant. This meant that the grant needed to be repaid in full by 31st December 2007. This has not yet been done. So which journal entry is required? You should know the journal entries to reflect the correct accounting treatment of the garment grant and the equipment in the financial statements of Goodwill for the year ended 31st December 2007. So, what should it be? First, let's start with it. Okay, property and plant equipment. Okay, debit 10,000, depreciation debit, liability. Okay, so first of all, this is correct, okay, because property and equipment and depreciation are debited and liability has to be credited. But now what you have to see is the figure. Is it right or not? Okay, so let us start one by one. When you have 3 things to do, okay, you have to check each one of them has to be correct. Each one in the item, all the 3 has to be correct for that to be correct. It's not just one. So let us start with property plant and equipment. What was the property plant and equipment cost? It was 90,000. They told it was netted off against the grant, which is 30,000. So 90 minus 30 is 60,000. Okay, and they told after year 1 the carrying amount was 50,000. So from 60 to 50. Okay, it was because due to depreciation, right? It was 10,000. Okay, so 10,000 depreciation was there. Okay, we know that. Okay, so 10,000 depreciation was there. Next, if there was no grant, okay, it was just 90,000 the equipment. Okay, then what would be the depreciation? Then the depreciation would be 90,000 divided by 6 because 6 useful year. That would be 15,000 into 2 because it was from 1st of Jan 2006 to 31st December 2007. 2006, the whole of 2006 and whole of 2007, 2 years are there. So multiply by 2, which will be 30,000, right? So 90 minus 30,000, which is 60,000. The carrying amount of, so originally the carrying amount was 50,000. You can see here. But if it was taken as fully grant, okay, the 90,000, you're not netting off with this 30,000 grant, you're just taking the cost. The carrying amount would be 90 minus that depreciation of 30 is 60,000. Okay, so from 50 to 60,000. Okay, 1st of Jan 2007 it was 50,000. 31st December 2007 it was 60,000. The carrying amount of plant and equipment. Therefore, it's 10,000, which is correct. Let us go to the depreciation. Okay, depreciation you only have to show the incremental depreciation. Before it was 10,000. Okay, we saw because 90 minus 30, which is 60, from 60 to 50 it fell down by 10,000. So 10,000 depreciation plus, not plus, the difference with the, if no grant was there, it was 30,000 depreciation. So the difference of 30 and 10 is 20,000. So depreciation also debit 20,000. And liability, what would be the liability? It is the grant, which is 30,000, right? So first one is correct. Okay, let us see the others also in case. So this one, liability is correct, but this two is wrong. Okay, property, plant and equipment depreciation expense. Next, the third one, we have debit retained earnings. The moment we see the debit retained earnings, it's wrong. And the fourth one is the amounts are changed. Okay, the depreciation amount went to property, plant and equipment. Property, plant and equipment amount went to depreciation. Okay, so it is this one. Next, I hope you are able to follow my instructions. Okay, next. So this is relating to IS 37. Okay, provision, contingent and all. Okay, the following two issues relate to Spyco company's mining activities. Issue 1 and issue 2. What are the issues? The company began operating a new mine in January 2003 under 5-year government license, which required the company to landscape the area after mining ceased at an estimated cost of 100,000. Issue 2 during 2004. Okay, this is the next year. Spyco's mining activities cause environmental pollution on an adjoining piece of government land. There is no legislation which requires the company to rectify this damage. However, company does have a published environmental policy which includes assurance it will do so. The estimated cost of the rectification is 1 million. In accordance with IS 37, which of the following statement is correct in respect of their financial statements for the year ended? Okay. A provision is required for the cost of both issues 1 and 2. Both issue 1 and 2 require disclosure only. A provision is required for the cost of issue but not for 2. For 2 only disclosure. Issue 1 requires disclosure, issue 2 could be ignored. Okay. To understand this, you have to be very good in your IS 37. You have to know all the rules and regulations. When something has to be disclosed, when something needs to be, when a provision needs to be there. You have to understand that first of all. Looking at the nature of an issue. Okay, so this is how the IS 37, the knowledge of IS 37, they are bringing this into a case study and they are telling you to solve this. Okay, so the correct answer is in this case is provision is required for both cost 1 and 2. Okay, why a provision is required for both cost and 1? You have to go through IS 37 to understand that. Next, so here you just, no option is there, you have to type an answer. Okay, and usually what happens is when you are not given an option where you have to write, mostly students go wrong in this area. Why? Because when option is there, by fluke also sometimes you get correct, even though you're not able to get it, you don't know the right answer, but sometimes by chance, by luck, you click that answer and you get it right. But here there is no such option. You have to be right or you're wrong. That's it. There's no luck. Okay, and mostly a calculation only will be asked where you have to type an answer, not a theory part. So Parket acquired 60% of Sukkot. That shows there is a subsidiary. Okay, more than 50%. The following extract has been taken from the individual statement of profit and loss for the year ended 31st March 2007. That is after 3 months. So you have been given the cost of sales, and Parket consistently made sales of 200,000 per month to Sukkot throughout the year. At the year end, Sukkot hold 200,000 of this in inventory. Sorry, 20,000 of this in inventory. Parket made a markup on the cost of 25% on all sales to Sukkot. What is the Parket's consolidated? See, it's Parket's consolidated, okay, because Parket is the parent company. He's the one who have acquired Sukkot. So he's the parent company. What is Parket's consolidated cost of sales for the year ended 31st March 2002 to the nearest whole dollar? So if your number is not to the whole nearest whole dollar, you will not be given the marks. Okay, even though technically you are right. So how do you start with this? Okay, you can either do it in your Scratch, but definitely you need a calculator to do this. Okay, you can show the workings in your Scratchpad if you want. So first of all, I'm going to add this from the parent company, 710,000. Okay, here I need the adjustment. I need to do a lot of workings with this. I cannot take it as it is, 710 plus 480. Why? Because first of all, this is, they are talking that they are making some sales to them. They have some inventory and some cost. And also this is for 3 months you have to take. Okay, for 3 months. So first of all, this you have to apportion it. Okay, this was given annually. Okay, this 480, you have to take it only for 3 months. So it will be 480 into 3 over 12. Okay, for 3 months. 480 into n over d. Okay, this function you use when you want to show something as a fraction. 3, and you click this and you go down 3 over 12. And you press this, enter. Okay, this solves a lot of issue, especially you have a multiplication and then a division, right? The reason is we are putting in fraction, then it will automatically take it, first multiply and then divide. Okay, sometimes it does not follow the bottomers. It depends on how you are inputting the numbers. Okay, so you might get an incorrect answer, so better to put it in terms of fraction if you are given a fraction. So 120. Okay, from here this 120 is now the cost of sales. From here you need to deduct what do you need to deduct? What do you need to deduct? You need to deduct this, the sales made, because it's an intra-group sales. Intra-group sales is always eliminated in the consolidation purpose. Okay, so 20,000 per month, that means how many months? This financial statement is for 3 months, so 20,000 into 3, so 20,000 into 3 is 60,000. Okay, so 60,000 is to be deducted from here. Next, you have to add, what do you have to add? A markup on the cost of sales, 25% on all sales, so that markup needs to be added. Okay, what is that markup? Plus, put a bracket. Okay, on this 20,000 only. Okay, on the sales they told 25% on all sales to Sukkot. Okay, markup cost of 25%. Okay, so when you're taking a markup, it will be 20, or you can write 20,000. Okay, okay, just put 20,000 because, okay, 20 into markup. What is the markup? 25. So when you're putting 25, you can again put this fraction. It will be 25, and you go down and you put what? Do you put 100? Do you put 100? Nope, you put 125. When you're working with markup, you add that 25% with 100. So your denominator will be 125. Okay. If your markup was 30%, it will be 30 over 130. That's how markup works. It's not 25 over 100. Close bracket equal to 64. Okay. So now the 64 needs to be added with this 710. What did you do with this? First you took 3 months, which is 3 months of this. Okay. Which was how much? Which was 120. From there you deducted the sales because intra-group sales, which was 60. Then you added the markup, which is, so the total is 64. Okay, that means markup is 4. So total is 64. Now you can add with the pocket company's cost of sales plus 710, which will be equal to 774. Okay, it is already no decimal, so you can take 704,000. You see. Next, a company has decided to change its depreciation method to reflect the pattern of its use of equipment. Better reflect the pattern of use of its equipment. Use the tokens to ensure that the following statement correctly represents this change and how it should be applied. Okay, so you have to say, you have to take from here. Okay, you have to drag and keep it. This is a change of accounting. Okay, is it a change of accounting policy or estimate, and must be applied retrospectively or prospectively. Prospectively means in future, retrospectively means in the past. You have to go back and change it. Okay, and this is in IAS 8. Okay, changes in accounting policy, estimates, and also that you have to understand, learn it. IAS 8. Okay, so what is it? It's a change in accounting policy or estimate. Change in accounting estimate. You have to understand, if a depreciation is changed, is it a change in accounting policy or an estimate? It's a change in accounting estimate. Okay, because when you're doing depreciation, you are estimating only. Next, there's a whole IAS 8 on that. Okay, you have to go through that, and must be applied retrospectively or prospectively. It must be applied in the future. When there's a change in accounting estimate, you don't go retrospectively, you do it prospectively. In the future, you keep changing. Okay, so this you have to understand, it's an IAS 8. Okay, so next, this is something to do with fair value movements. Okay, included within the financial state assets of Zinet are the following two recently purchased investments in publicly traded equity shares. Investment 1 and Investment 2. Investment 1 is 10% of the issued share capital of Haruka. This shareholding was acquired as a long-term investment as Zinet wishes to participate as an active shareholder of Haruka. 2 is also 10% of issued share capital of Lucas, another company. The shareholding was acquired for the speculative purposes, and Zinet expects to sell the shares in the near future. Neither of the shareholders gives Zinet significant influence over the investing companies. Wherever possible, the directors of Zinet wish to avoid taking any fair value movements to P&L so as to minimize volatility in reported earnings. How should the fair value movements of these investments be reported in Zinet's financial statements for the year ended 31st March 2009? Which IFRS or IAS is this? First, you have to identify that. Once you identify that, you will be able to know the steps, how it should be recorded or something. Okay, this is IFRS 9, your financial instruments. So in your financial instruments, we have financial assets. Okay, under financial assets, we have been taught when to recognize in P&L, when to recognize in other comprehensive income, or when to recognize in P&L for other comprehensive income first and P&L. Okay, so we have been taught. Okay, so this, is it in P&L for both investments, or in other comprehensive for both investments, or P&L for one investment and comprehensive for the other one, or comprehensive for investment 1 or P&L for investment 2? What is it? It is, the right answer is, it is in other comprehensive income for investment 1 and P&L for investment 2. Okay, why is that? The difference, I will tell you why the difference is. Why in the P&L, sorry, it's other comprehensive income. Okay, why other comprehensive income for investment 1? The reason is, you are not selling it, you are an active shareholder. Okay, it's a long-term investment. Okay, and you are an active shareholder. So when you are not selling it, active shareholder, it's recorded under other comprehensive income. But when you are selling it, okay, this is for speculative purpose, and you are selling the shares in the near future. The profit you are getting once you are selling, you are not holding the shares anymore. It will be recorded in P&L. It's a rule for financial assets. That's why the last one is correct. Next, Sheba entered into a lease for a right of use asset on 1st of Jan 2007. You will be asked a lease, okay? A lot of leases there. So the lease contract is for 4 years. That means it's a short-term lease, and the useful life of the asset is 6 years. Information relating to the lease is as follows. So you have been given the initial lease liability, deposit, direct cost, maintenance cost. What will be the carrying amount of the right of use asset? What is this right of use asset? If you're seeing this video for the first time, you'll be wondering. If you haven't gone through the lease, like if you haven't studied lease before, you'll be confused, right? So for that, you have to study lease to know what is right of use asset. Okay, which will be taught in financial reporting. Okay, so you have to know how a right of use asset will initially be measured at. Okay, carrying amount comes later. So initially, the right of use asset will be measured at what? That you have to understand. It will be measured at 55,000. How 55,000? How is it 55,000? Addition of these three. Initial lease liability, deposit, and direct cost. You add 48 plus 2 plus 5. That's how you initiate. It's a rule, okay? So you initially measure right of use asset by this, which is 55,000. Then asset will be depreciated over how many years? 4 years. Lower of this, the useful life of the asset of the 4 years. The shorter of this, okay? You always have to see the shorter of this in the lease. It's a rule again. Whichever is shorter. Here, the lease contract is shorter. Useful life is 6, but lease is 4 years. So you have to divide it by 4 years. Okay? So the carrying amount at the end of year 2, because this is 1st of Jan 2007 and this is 31st December 2008. At the end of year 2 only, okay? Whole of 2007 and 2008. So at the end of year 2, which will be 30, which means 1st December 2008, will be how much? The 55,000, the initial amount of right of use asset. Let me take a calculator. 55,000. Okay, you divide this by 4. Okay, then you have to take it into 2 because for 2007 and whole of 2008, which is 27,500. 27,500. So the answer is 27,500. This is the answer. Okay, after you deduct the depreciation. Next, the question comes, why the maintenance cost we didn't take when we were taking the value for the right of use asset? So right of use asset is a non-current asset, okay? Why maintenance cost? Because this maintenance cost we are taking it as an expense, okay, over the life of the contract. This will be expensed. You cannot take it as initial cost for the right of use asset. It's like you are not capitalizing this. The deposit and the direct costs are capitalized, but this is not capitalized. This is expensed. Okay, go and learn leases. Okay, so 27,500. Next, Trust and Company operates in an emerging market with a fast-growing economy where prices increase frequently. Which two of the following statements are true when using historical cost accounting compared to current value accounting in this type of market? So we know that there are many ways of calculating something. One is known as historical cost accounting, the other one is current value accounting. Okay, make sure you know what are these two. Okay, so which of these two statements are correct? You need to select two to get the marks. Okay, if you select one also and if it's correct, you will not get any marks. It will be awarded 0. Both has to be correct. Okay, if one is right, one is wrong, you will not be getting the marks. So first one, capital employed which is calculated using historical cost is understated compared to the current value capital employed. Right? It is correct, right? Because historical cost will something be less, okay, compared to the current value capital employed. It will keep on increasing. That's why if you are calculating the capital employed using historical cost, it will be understated. Next, historical cost profits are overstated in comparison to the current value profits. Yes. because you can see it's a fast growing economy, emerging market. So there will be so many other costs which will be coming up in the future, which was not there in the past, historical. That's why historical costs are overstated compared to the current value profits in this type of markets. Let us read the other two also. Capital employed which is calculated using historical cost is overstated and historical cost is understated. No. Next. Patola Company acquired 80% of Sanka Company on 1st of October 2005. 80% it shows is a subsidiary, okay? At this stage, some of the Sanka's inventory had a carrying amount but a fair value, and 70% on 31st December 2005. So October, November, 3 months. After 3 months, 70% inventory has been sold to Sanka. It's an intra-group sales, okay? Again eliminated. The individual statements, so you have been given the inventory of both the companies. Remember previously we were given a question on cost of sales, now we are given on inventories. So what will be the total inventory figure in the consolidated financial statement? So this is a similar question to that, but this is now inventory. That was cost of sales. So now you should be able to understand this. Okay, so you add this 3250 with this Sankat company's inventory, but here you need to do adjustments. Okay, with this 91940. Okay, here you don't have to take it for 3 months. Why? Because already it is taken at 31st December 2005 only. It is taken for 3 months only, this 1940. With this, okay, what do you have to do? What do you have to do? You have to add. Okay, so it's like this. In the calculator, if you put, it will be 3250, okay, which is from Patola, and then you are adding with the Sanka company plus 1940 plus in bracket 800, because look at the carrying amount was 600 but the fair value, so you are taking the fair value. Okay, from that fair value deduct this. It has a carrying amount of 600. It's a profit, right? It's like increase in the value of inventory from 800, so they take the difference, multiply by 30%. Why 30%? Because 70% of this inventory has been sold. Okay, so 70% has been sold by Sanka. So what is remaining for Sanka? 30%. The balance is remaining. This is not cost of sales, this is inventory. Okay, so which will be what? So if you see this option is not in the list, that means your calculation something went wrong. What went wrong? What went wrong? Can you tell me? Okay, so the reason is this went wrong. Okay, when we put in the calculation, not able to see it. So when you took that 800 minus 600 into 30%, what they did was, I told you this is why you cannot always rely on the calculator also. When it's a long calculation, you are supposed to take the difference into 30%. So when you took 800 minus 600 into 30%, they took 30% of this 600 first and then they deducted by 800. That's why the difference came. Okay, so now you have to break this. 800 minus 600 is 200, so 200 in 30%. The difference you have to take 30%. 60. With this you are adding 1940. With this you are also adding 3250. Okay, so now you see it's 5250. So immediately you should know when a calculator is giving an answer something not on the list is wrong. Sometimes what happens is calculator might give you incorrect answer, but the answer is there in the list. So don't be too quick. Sometimes you might have to recheck your answer also. You have to recheck in the calculator, especially when what mass you have to follow. When multiplication is there, addition, subtraction, together everything is there, you need to check again. So it's safe side, okay? In order to be safe, it's better to do it separately rather than doing it in one go. Sometimes the calculator, okay, let's say like this, you have put 800 minus 600 into 30%. First they will take the multiplication, then they will deduct, right? But it was supposed to be the other way around. First you are supposed to deduct 800 and 600, then you are supposed to multiply it by 30%. So in that case, don't do it in one go, step by step, okay? Now, so this is something relating to statement of cash flows, okay? Top trade has been trading for a number of years and is currently going through a period of expansion, and an extract from the statement of cash flow is presented, okay? You have been given, and you can see operating as positive, but investing and financing activities is negative, okay? Next, which of the following statement is correct according to this? The company has a good working capital management. Net cash generated from financing has been used to fund the addition to non-current assets. Financing has been used to fund the addition of non-current assets. Definitely this is wrong, okay? You have to understand, because we don't use financing activities for the addition of non-current assets. Net cash generated from operating has been used to fund the addition. No, we don't use operating activities to fund non-current assets. We use what? Investing activities. Okay, so definitely this two is not the option. Existing non-current assets has been sold to cover the cost of additions to non-current asset. So definitely the answer is the first one or the fourth one. Sorry, I'm sorry, something went wrong. Net cash generated from operating activities has been used to fund the additions to the non-current assets. Yes, it is this one. Why? Because sometimes you can use the cash from the operating activities to finance the addition to the non-current assets. I'm sorry for that mistake which I told, okay? Okay. Next. Rooney Company acquired 70% of equity share capital of Marek, its only subsidiary, on 1st of January 2006. The fair value of NCI at acquisition was 1.1 million. At that day, fair value of this net assets were equal to their carrying amount, except for a building which had a fair value above its carrying amount and 30 years remaining useful life. During the year 31st December 2006, he sold goods to Rooney, giving rise to an unrealized profit in inventory. At the year-end, Merck's profit after tax for the year ended 31st December 2006 was 3.2 million. What amount will be presented as NCI in the consolidated statement of financial position? Good. So you have to know how to calculate NCI. Okay, a formula is there. How to find NCI? Okay. So NCI is, the formula is fair value of NCI at acquisition. What was the fair value at acquisition? It was 1.1 million. Then what do? We add the profit. We deduct the depreciation and the unrealized profit. What was the profit for the year? And you have to take 30% of that profit, because 70% is for NCI, okay? Sorry, 30% is NCI. So or what you would do is, there are two ways of doing this. You can either take 30% of 3200 and add, or you can take all the figure as it is and at the end take the 30%. Okay, so let us first take 3200. We'll take it at the end. Okay, 3200 minus depreciation. Depreciation is how much? What was the value for the fair value of building? Is 1.5. which will be divided by how many years? 30 years, because 30 years remaining useful life. So 1.5 million divided by 30 is 50. Okay, so 3,200, the profit, minus the depreciation 50, minus unrealized profit. Unrealized profit is 550,000. Okay, so it's like this when you're taking it. It will be 3,200 minus the depreciation 50 minus the unrealized profit 550. Okay, now you can take the 30% of this, 780. So with this you are adding 1,100, the opening fair value, which is 1880. See, okay, because you are supposed to take the 30% of all the unrealized profit, depreciation and profit. That's why first you take as it is the everything, and then at the end you take 30%. It's not just the profit for the year which are 30%, everything, even the depreciation and unrealized profit will be 30%, 30%, 30%. Next, when gain when a gain on a bargain purchase negative goodwill arises, IFRS 3 requires an entity to first of all review the measurement of the assets, liabilities, and consideration transferred in respect of the combination. Use the tokens to ensure that the following statements correctly describes how negative goodwill should be recognized. Okay, so you have to select from here the tokens. Okay, so when the negative goodwill, okay, the word accounting entry says you have to select from here. Okay, you cannot select from here and paste it here. Okay, it will not go. It will not even go. Just say. You have to select from here this two, either this or either debited or credited. So when the negative goodwill is confirmed, it should be debited or credited. It should be credited. Why? Because goodwill is debited, so negative goodwill should be credited. You see? And to financial statements, that means from financial statements you have to select. It should be credited to what? Retained earnings, profit or loss, positive goodwill. It should be credited to P&L, profit or loss. Okay. Next. So another similar type of question came. This is for total equity, okay, which we were asked for cost of sales and inventory. On 1st of October 2005, Anita purchased 75,000 of Benita's 100,000 equity shares when Benita retained earnings an amount to 90,000 on 30th September 2007. That is after 2 years. The extras from the financial statements are given. Okay, you have been given the equity, return, and the total. What is the total equity which should appear in Anita's consolidated statement of financial position at 30th September 2007 years? So how do you do this? First of all, see, equity, okay, will only be of Anita's. You don't consolidate Benita's equity also. No. When you are taking equity, is only the parent company's equity we are taking. So the working is with the retained earnings. Okay, when you are taking the retained earnings, you are taking 300,000 from Anita. There it's simple. The working comes in Benita's retained earnings, 150,000. With this 150,000, what do you have to do? First, you have to deduct the 90,000 because you are taking only the post-acquisition earnings. Okay, so this 150 minus 90, because when it was acquired, it was 90,000. Suppose acquisition earnings 150 minus 90, okay, into 75%. How into 75%? We have not been given a percentage. How much it has acquired? Simple. When they don't give you a percentage, just see how many shares they have purchased. So they purchased 75,000 of 100,000. So 75,000 divided by 100,000, which is 75%. That means, in other words, they are trying to say they have purchased 75% equity shares. Okay, so that's why you have to take 75%. So if you're taking in the calculator, it will be 150 minus 90. On that you are taking 75%. With this you are adding 300. Return earnings from the parent company. With this you are also adding the equity shares of only the parent company, Anita. So the answer is 1595. Sorry, it's not 1250. You see, this is why you have to do proofreading. When you are putting in the calculator, so sometimes you might get wrong. Rather than putting 125, I put 1250. So just deduct 1250 back and add 125. Okay, 470. Proofreading. You always have to do proofreading because it's more easier to make mistakes in CBE platform. Even though it's easier, but it's more easier to make mistakes. That's why you always need to check proofread. And finally, the last question in section A. Okay. On 1st of October 2001, Bash borrowed 6 million for a term of 1 year exclusively to finance the construction of a new piece to production equipment. The interest rate on the loan is 6% and is payable on maturity of the loan. The construction commenced on 1st of November 2001 after 1 month. But no construction took place between 1st of December to 31st December 2002 due to employees taking industrial action. The asset was available for use on 30th September 2002 having a construction cost of 6 million. What is the carrying amount of the production equipment in Bash's statement of financial position at 30th September 2002? Okay, workings are required here. What is the working? What is the production cost of PPE? It is 6 million. Okay, this will be capitalized. Why? This was exclusively used to finance the construction of new piece of equipment. Okay, next. Sorry, this 6 million is this 6 million. Okay, there are two 6 million. This one. Next, borrowing cost. Okay, so this is IAS 23. Okay, borrowing cost where they may talk about borrowing cost. So this borrowing cost you have to capitalize this 6 million. Okay, because you have used it, you have taken it to finance the construction of a new piece of production equipment. Okay, so what are you going to do on the 6 million? How do you capitalize? You have been given the percentage, the interest rate of the loan, which is 6%. So you apply 6% on 6 million into how many months? Into 9 months, only for 9 months. Only for 9 months. So let us do that. So 6%, that means 0.06 into 6 million. Yes, let me just put million. Okay, into 9 over 12, which will be 0.27 million. Okay, or 270,000. So this 270,000 will also be added with the 6 million construction cost. Okay, so the total cost will be 6,270,000. 6,270,000. The full amount you need to write. Don't just write 2670. Don't write. Don't drop the 3 zeros and write. When you're writing the answer, finally you have to write the full answer as it is. If it's in million, you have to put the 6 zeros. Okay, so this is 627,000. 6,270,000. Okay. So now the question comes is why 9 months? You cannot take it the whole year. Okay. Why 9 months only? You have to count the number of days. But from when are you calculating the number of days, number of months? When is the time? There is also a rule for that also. When you can take and when you cannot take. So just think. Because if you see, it's from 1st of October 2001 to 30th September 2000 is 1 year. But why only 9 months? Why that 3 months is out? The reason is because they told the construction commenced on 1st of November 2002, but no construction took place from 1st of December 2001 to 31st January 2002. Okay, due to employees taking industrial action. So even though the construction commenced on 1st of this one, they're not taking place. So just take the 3 months out: November, December, and January. Okay, so out of that 12 months, 3 months is out. When it's not being used, it's a rule that you cannot take it when you're capitalizing it, when it's not being used. So that's why it's 9 months. Okay. So now next, with that, I finished section A. Section B, we have 5 questions. Okay, each case study will be having 5 questions. So 3 cases we have, and 3 cases will be having 5 questions. Since that again 30 marks. So again 30% of marks is from section B question. So which will be continued in inshallah in part 2. So make sure that you watch my other videos as well, because I have been following with consistency the other papers as well, the way I'm doing financial reporting. And I hope this shall help those students to have an overview of financial reporting. And don't forget to share those videos among your friends who is planning to take financial reporting paper and is lost what other things coming and all. Okay, so inshallah, see you in the next video.